$1 million sitting in your 401k, $0 in a taxable brokerage account. Follow the textbook withdrawal order anyway, and the IRS can hand you a tax bill of nearly $14,000 in a single year. Your federal tax bill goes from $0 to income taxed inside the 22% bracket. A Medicare surcharge can be waiting right behind it, one that can keep coming back year after year if your income stays that high. Not because you did anything wrong. Because the advice everyone repeats, spend your taxable account first, protect the tax-deferred money for later, was built for a 3-bucket household. You don't have one, so you do the only thing that advice leaves you. You touch the 401k as little as possible and let it ride, while the IRS's schedule keeps running underneath it. That habit feels responsible for years. The IRS calls it something else, a required minimum distribution quietly building on an account nobody was managing down. Here's the part almost nobody shows you, what this looks like with no brokerage account to soften it. No second bucket to draw from first. No cushion, just one number, growing in the background until the calendar forces your hand, all at once, in one tax year, on the IRS's schedule instead of yours. I am your guide to the retirement math that generic withdrawal order advice always skips. One bucket, a decade near a $0 tax bill, one forced cliff, one fix that stops it years before it happens. In the next 15 minutes, you'll see exactly where that cliff comes from and the specific move, filling your emptiest tax brackets on purpose before the IRS fills them for you, that defuses it years before it happens. Right now, a small withdrawal like $12,000 a year can produce a $0 tax bill. That feels like a win. Wait until you see what it quietly sets up. Quick favor before the numbers start. If breakdowns like this are useful to you, tap like and subscribe now so the next one finds you. Part 1. The order everyone repeats and the assumption baked into it. The standard withdrawal order taught in almost every retirement guide runs in 3 steps. Spend your taxable brokerage money first, since it's already been taxed and carries the least urgency. Then spend your tax-deferred money, your 401k, your traditional IRA. Save your Roth for last, since it's tax-free, and you want it compounding as long as possible. That order makes sense for a household with 3 buckets. It was built for that household. You have one. The order assumes you built 3 buckets during your working years. If you only ever built one, because your employer's 401k was the retirement plan and nothing else, the order collapses into a single instruction. Hold on to the one thing you have. That's exactly the instinct that lets the balance run unmanaged for a decade. No taxable brokerage account means step 1 of that order simply doesn't exist for you. There's nothing to spend down while your 401k sits untouched. So the instinct the order trains into every retiree who follows it becomes your entire strategy, applied to the only account you actually own. The rule wasn't wrong. It was never written for you. Here's the number that should worry you instead. Some financial planners have a term for it, the ideal tax-deferred balance, the amount where your eventual required withdrawals land at or below your standard deduction, so you owe close to 0 federal tax when they arrive. For 2026, that deduction is $16,100 for a single filer, plus another $2,050 once you turn 65. This walkthrough uses that base deduction only, not the extra temporary senior deduction some filers can also claim for 2025 through 2028, which would only make the early years even more tax-free, and which expires well before the required withdrawal year in this example. A $1 million 401k, left alone and compounding for a decade with only minimal withdrawals, blows past that ideal balance by a wide margin. The order that told you to protect it never mentioned that protecting it too well is exactly how you get there. Part 2. The years you pay almost nothing and why that isn't the win it looks like. Say you're 65. You retire with exactly $1 million in your 401k and nothing else. Social Security pays you roughly $31,000 a year, a reasonable career average benefit for illustration. You need about $43,000 a year to live. $31,000 comes from Social Security. The other $12,000 you pull from the 401k, the smallest withdrawal you can get away with, because that's what the textbook order trained you to do. Now, run the actual tax math. The IRS uses a formula called provisional income to figure out what share of your Social Security check counts as taxable, your other income plus half your benefit. $12,000 plus half of $31,000 comes to $27,500. For a single filer, using the provisional income thresholds commonly cited for this rule that crosses the $25,000 line where Social Security starts becoming taxable at all, but stays under the $34,000 line where the steeper 85% rule takes over. So only about $1,250 of your benefit counts as income. Add that to your $12,000 withdrawal. $13,250 of total income. Your standard deduction alone, $16,100 plus $2,050 for being 65 or older, wipes that out completely. Your federal tax bill, $0. For 10 straight years, that's your number. 0. Year after year. It feels like winning. No tax, 10 years running. What's not to like? Here's what that feeling hides. You're not avoiding tax. You're leaving the entire 10 and 12% brackets sitting completely empty, every single year. On income, you could have realized at that rate, and never will again. While the balance sitting behind those unused brackets keeps compounding, untaxed, waiting for the 1 year the IRS stops letting you decide. Some planners call the eventual bill a tax torpedo. Whatever you call it, the mechanism is the same. Every dollar of low-bracket room you don't use during these years is a dollar of high-bracket tax you're volunteering for later. Part 3. The year the IRS stops asking. Required minimum distributions start at 73 for the 1951 to 1959 birth cohort, or 75 for anyone born in 1960 or after. For this walkthrough, we'll use 75, 10 years after you retired at 65. During those 10 years, your account wasn't just sitting there. It was compounding, largely untouched. Using a simple 7% average annual return and a typical 2.5% yearly Social Security cost of living adjustment, both standard planning assumptions, not guarantees, your $1 million 401k grows to somewhere around $1.8 million, even after 10 years of those small withdrawals. Your Social Security, compounding the same 10 years, rises from $31,000 to roughly $39,700 a year. Now, the IRS requires you to withdraw a set percentage of that balance every year for the rest of your life, roughly 4% of the account at 75, under the government's own life expectancy tables. 4% of $1.8 million is $72,000. Not optional, not negotiable. That withdrawal happens whether you need the income that year or not. Run the same provisional income math. $72,000 plus half of $39,700 comes to almost $92,000, miles past the $34,000 line. Now the steeper rule applies in full. 85% of your Social Security, $33,745, counts as taxable income. Add it up. $72,000 from the required withdrawal, plus $33,745 from Social Security, comes to $105,745 before your standard deduction. Subtract that deduction, and taxable income lands at $87,595. Last year, you paid 0 federal tax. This year, that number sits solidly inside the 22% bracket, a bracket you never touched once in the 10 years before it. And it doesn't stop there. That same $105,745, your modified adjusted gross income, or MAGI for that year, puts you within about $3,000 of the very first Medicare income surcharge line for 2026 for a single filer, currently $109,000. One stronger market year, one bigger cost of living raise, one extra year of growth before you retired. Any one of those, and you're not near that line anymore. You're over it, paying an extra $81 a month for Medicare Part B for that Medicare year, because your income from 2 years earlier crossed one number by a few $100s. And it can happen again any year your income repeats the pattern. Married and filing jointly, the exact dollar lines move. The Social Security thresholds sit at $32,000 and $44,000 instead. The tax brackets are roughly double, and the Medicare surcharge line starts at $218,000 instead of $109,000. The dollar figures shift. The mechanism, a decade of near-zero tax followed by a forced cliff, does not, and the required percentage doesn't stay flat. Every year you age, the IRS shortens your official life expectancy on its own tables, which means the share of the account you're required to withdraw climbs. Not just this year, but every year after it, for as long as you live. This isn't a one-year mistake. It's the first year of a pattern. Part 4. The fix, and it doesn't require a brokerage account you don't have. If you have no taxable bucket, the answer isn't to invent one. It's to stop treating the 401k like something to avoid touching, and start treating those 10 low-income years as the cheapest tax bracket space you will ever be offered. Here's the version that works. Instead of withdrawing the bare minimum $12,000 a year, withdraw enough to fill your income up to the top of the 12% bracket, using 2026's published single-filer bracket structure that's around $50,400 of taxable income. There's a catch worth naming. A bigger withdrawal also makes more of your Social Security taxable, so the number isn't just the bracket top minus your deduction. Working backward through that same provisional income math, it lands at pulling around $42,000 a year from the 401k instead of $12,000. You still spend the same $12,000 you always needed. Take that as cash. Convert the other, roughly $30,000 directly from the 401k to a Roth IRA. A trustee-to-trustee move, not a withdrawal you take and then redeposit. Depending on how your plan is set up, this may run through a rollover step first. Confirm the mechanics with your plan administrator before you move anything. You pay tax on that conversion now at 10 and 12% rates. Do the math on one of those years, and it comes to a little over $5,800 in federal tax, roughly $58,000 total across the 10 years, spread out, planned, paid on your terms, while the brackets are cheap. One rule matters here. The tax on that conversion should come from money outside the 401k, your regular bank account, not the retirement account itself. Pulling extra dollars out of the 401k just to cover the conversion's tax bill adds even more taxable income to the same year and defeats the purpose. Plan the conversion size around what you can pay for in cash, not around what feels like a round number. Compare the two paths. $58,000 total, spread across 10 years, at 10 and 12% rates, or nearly $14,000 in a single year the moment RMDS start, repeating and likely climbing every year after that, plus a real chance of an extra Medicare surcharge riding on top of it, year after year, for as long as your income keeps landing above that line. And the account left behind for the RMD math is a fraction of the size it would otherwise have been, because roughly $300,000 of it moved into a Roth during the decade when moving it cost the least. Money inside that Roth stops generating required withdrawals for you, and qualified withdrawals from it generally don't count in a future provisional income calculation or push you toward a Medicare surcharge line the way the same dollars would coming from a traditional account. The same one-bucket problem that created this trap is exactly what the fix uses against it. Every dollar you move out of the 401k during the empty years is a dollar. The IRS can never force out of you later, at a worse rate, in a worse year. Run this with your own numbers before your next birthday. The top of the 12% bracket changes slightly every year, but the years you have left to use it do not grow back. Here's the one rule to take from all of this. An empty tax bracket in a low-income year is not a bracket you saved. It's a bracket you wasted, because the IRS will fill it for you eventually, on its own schedule, not yours. That's the whole idea behind planning at all, using the years you actually have, on your terms, instead of the IRS's. Before you close this video, pull up your own 401k statement and your last tax return, and check one number. How much of the 12% bracket did you actually use last year? If the answer is close to zero, that isn't a compliment. That's the gap this video just showed you, sitting in your own numbers. This is not financial advice, and not legal advice either. Run your own household's real numbers with a fiduciary before you make any decision based on any of it. If this reshaped the way you see your own 401k, hit the like button, subscribe if you want more of these year-by-year breakdowns, and drop the word bracket in the comments.